Zaner Ag Hedge, bringing you a strategy of the day update here for October 14th, 2021. Remember, trading futures involves risk and is not suitable for all investors, and everything I talk about here today is just my own opinion and not a direct trade recommendation. With all that being said, let's take a look here at the daily chart of the November soybeans. There we go. Trading into the end of the day at 12.06 and a failure to break below that $12 figure seems like a pretty good capitulation of a key psychological level that could see reversal higher here now for the soybeans. November beans now below their 18-day moving average at 12.51, the 55-day moving average at 12.98, and the 100-day moving average at 13.27. That 200-day moving average at 12.85, we're below all of those moving averages at this point. Excuse me, and as well a trendline resistance that we've been holding below since June timeframe. The June low at 12.40, coupled with the lows, but in the month of September through August, or August through September rather, from the 12.80 to 12.60 area. That area is going to definitely be some kind of interesting resistance to watch to the upside here, as I think beans try to make a bit of a harvest low and a bottom. It's going to be important to watch for a break back above the 12.10 area for November beans. That would be a back above, not yesterday, but the day before that's high. And that would suggest, a nice reversal outside this inside price action we had today, albeit very, very supportive price action that much higher might trigger that short covering rally. We really need to see that happen here pretty soon, because we don't want the market to dilly-dally too long down here, because that will keep that pressure on the market and honestly the downtrend intact at this point. However, I do believe that we are getting close to a bottom if we don't have one already here for November beans, and I have been starting to make the recommendation for call spreads here today. So with that being said, we'll take a look at what some of those strategies look like tomorrow in the strategy of the week forecast. That will be held at 2 p.m. tomorrow, Friday. I'm moving it one day down because of the holiday on Monday, but I think it's worth taking a look at some of those, call spreads through the January and March timeframe that I think now could be put to work in the market, because we're starting to see maybe a bit of a harvest low form. Today, for soybeans, we saw another 132,000 metric tons sold to unknown destinations for a daily flash sale. Seeing those export numbers start to come in alongside a lower price, to me suggests that the market is now starting to find that demand, that this lower price on the charts is what was hoping to entice. So from a 4-hour perspective, soybeans find themselves now running into that supportive area we've been talking about here for the last several months, between the $12 and the $11.40 area. The 11.83 lows here, that is the equal legs, or from 14.80 down to the 12.40 lows. That leg expanded lower here from this 12.43 or 14.23 high. That equal legs down, that is an interesting Fibonacci measurement, or an equal legs technical level that gave us kind of part of the landing zone here that we are looking for the market to capitulate down into. Now that we're breaking back above $12, I think that this reversal so far has the best opportunity to continue with that momentum higher. And if we start to see it break some of these key short-term levels that break back above 12.10 to 12.14, that could take us towards 12.20, and certainly a retest of this trendline resistance now that we've been holding in the market comes in around 12.30 at this time. It'd be highs to highs here. Breaking above that level could get a retest of the larger downward sloping trend line around 12.60, 12.75, and then now we're really breaking out if the market were to be going higher. But moral of the story is I think we need to get back to, and I alluded to this just a moment ago on the other chart, this 12.40 to 12.60 area, this blue box or this congestion zone where there was some prior lows, broken support, needs to be tested as resistance, and maybe not at all. Maybe we continue through it and we continue higher, and we have a true low like we saw last year, all based on a strong demand-driven market. So we're going to continue to watch that for soybeans. That's really the key thing I wanted to kind of call to everyone's attention, that it looks like in the short term here, the reversal that's begun, if it continues with this momentum higher, it could really stage for a true harvest low and make for a capitulating low to have formed that we've been talking about, and that very annoying word capitulation that finally I think has occurred. With all that being said, let's take a look here at December corn, because equally impressive kind of sell-off here that finally occurred. I've been talking about how impressed I was that corn was holding up a few days ago here above the 530, above the 520 area. Now that we've broken down back to the low end of the range, corn just does feel like it is in that larger sideways type of range-bound price action. And I am concerned that we're below that 100-day, 55-day, and 18-day moving average. Now, today was the first day we traded for the entire day below this 200-day moving average of 518. That's could be a technical signal for some more weakness here. And as we make our way down towards the 4-hour chart in a minute, you'll see that there's some other technicals and reasons that I would like to see corn get back to 550 to 560 to feel a lot more comfortable with it. There is still an open gap down below us around 477. We break down the $5 handle that we've been holding and watching the market hold as a pretty solid support. I mean, you can't. Oh well, I'll just have